Welcome back. In this session, I will be explaining to you how to recognize revenue. We have seen about income statement and also how income is defined. Income includes both revenues and gains. Revenue is income arising in the ordinary course of an entity's activity and may be called in different names: sales, fees, interest that received, dividends, or royalties. IFRS 15 Revenue from Contracts with Customers was issued in May 2014. It was the result of a joint IASB and FASB project on revenue recognition. It seeks to strike a balance between the IASB rules in IAS 18, which were felt to be too general, leading to a lot of diversity in practices, and the FASB regulation, which was thought to be too numerous. So IFRS 15 effectively replaced both IAS 18 revenue and IAS 11 construction contracts. Under IFRS 15, the transfer of the goods and the services is based upon the transfer of control rather than the transfer of risk and rewards, as in IAS 18. The control of an asset is described in the standard as the ability to direct use or obtain substantially all of the remaining benefits from the asset. For straightforward retail transactions, IFRS will have little effect on the amount or timing of revenue recognition. For contracts such as long-term service contract like construction contracts or multi-element arrangements, it could result in changes either to the amount or to the timing of revenue recognized. So, what does the IFRS 15 covers? It is concerned about the recognition of revenue arising from fairly common transactions like the sales of goods, the rendering of services, the use by others of entity assets yielding interest, royalty, and dividends. Generally, revenue is recognized when an entity has transferred promised goods or services to the customer, and it has set out 5 steps for the recognition process. And those steps are: identify contracts with the customer, identify separate performance obligation in the contract, determine transaction prices, allocate transaction price, and recognize revenue as a performance obligation is satisfied. The idea is to, through those steps, it allows one to depict the transfer of goods and services to a customer in amounts that reflects the consideration to which the company expects to be entitled in exchange for those goods or services. So let's have a close look. Step 1, identify the contract. A contract is agreement between 2 or more parties that creates enforceable rights and obligations. The requirement about this would be it needs a commercial substance and to be probable that payment will be made. Parties have approved the contract and committed to their obligations. The entity can identify each party's rights and payment terms. There are also rules for combining and modifying contract, which is not covered in this session. Step 2, identifying separate performance obligation. A performance obligation, aka PO, is a promise in a contract to transfer a good or service. Distinct POs are accounted for separately, those which are not combined until there is a bundle of goods or services which are distinct. A PO is distinct if entity regularly sells it separately, where a customer could benefit from the goods or service on its own or together with readily available resources. A series of distinct goods or services that are substantially the same and have the same pattern of transfer are treated as one PO. This is an important new feature of IFRS 15 compared to IAS 18. It is important because the revenue will be allocated to each PO. Warranties such as the assurance type of warranties but also includes service type of warranty. Assurance type of warranty would be a warranty for product to work as intended. They were not being treated as separate PO, but service type of warranty are treated as separate PO because these services can be purchased separately. And there are some rules about principals versus agent or customer options, which again is not covered. Let's just take a look of examples that you can. Before you continue with these slides, I would like you to pause the video and look to your textbook. Find the activity 18.4 on a software company and read the example and try to apply the steps that we have just explained to find if there is a contract and to identify how many POs they are. We can derive from the example that there is a contract that it sells the software license, install the software, provide software updates and technical support for 2 years. We also know that the company sells the license, installation services, updates, and technical support separately. The software would remain functional without the updates and technical support, so you would be able to see itself as a distinct PO. So one way you could see it is as a promise to transfer each good, which is license, installation, update, and technical support. They can be treated separately and they comprise 4 POs. But if you assume that the software needs to be customized as part of the installation, now the installation services and the software license are no longer as treated as separately identifiable. So they would be considered as one PO. Then we would see 3 POs in this particular contract.